All right, we'll start in a minute. I will shift back to PPT. Okay, good morning, everyone, again, and thanks for joining. I hope you will get some learning out of this particular session, and then especially thanks to all of you for joining on a Sunday morning. If not this session, maybe you might be enjoying some movie or something or some play, but this is a good way to learn something. So we got about 150 people live. I think I will try to make this video available after the session, but depending on how the session goes, right? So, but however, I suggest and request you to make some notes in case if I have to pull back the video, it will be at least easy for you to refer back. But you can always reach me, and that's where we will actually get in touch. And as of now, you can get in touch with me for through Twitter and YouTube. Those are the two channels. I do not have any WhatsApp group or Telegram, and I'm not planning to do anything soon at this point of time. But yeah, Twitter and then YouTube are the main channels. All right, so let me get back to the session for today. And before that, I wanted to ask a question to you, right? I know most of you did a polling, but I quickly let me know how many years of trading experience you have. I'm not talking about the stock market, just the trading. When I say trading, I'm definitely talking about the derivatives, either it is futures or options. You just put a number there that I'll get some good idea of what's your experience. So we got 4, 3, 5, okay, 2, 4 months, okay. All right, okay, 18 months and 6 months, 3, 4. Okay, let me show some of the things on the screen. So I think we have one person, 20 years. That's great. So somebody, Venkata Krishna, said that almost 1 year, but all gambling type. Yeah, we'll cover that definitely. So I would think you are doing mostly option buying. When you say gambling, that's what it is. Awesome. So 1993. Okay, that's too far. Actually, that should be 30 years, not even 20 years. All right, that's fine. So let me get on to the session, right? So before I go ahead with anything, I think it's important for you to look at the disclaimer. So the disclaimer is, I'll let me read this so that there is no confusion, right? So the content provided in this presentation is for educational and informational purposes. And you should not consider this as a financial advice and investment advice and trading advice or any other advice. The information presented is based on my personal experiences and research and does not guarantee any specific results. Trading derivatives, including futures and options and other financial instruments, involve a high level of risk and may not be suitable for all the investors or traders. Before making any investment or the trading decisions, it is important to conduct thorough research and consult with a licensed financial advisor or other professionals to understand the risks involved and to determine if trading derivatives aligns with your individual financial situation and goals. And past performance is not indicative of the future results. The views and opinions expressed in this video are the presentation are those of me, and do not necessarily reflect the official policy of the position of any other agency or organization. By attending this presentation, you acknowledge that you are aware of the risks involved in trading derivatives and agree that the creators of this video are not responsible for any losses or damages resulting from your trading activities. I think that's important for you to know. And also, as we go, I will also refer to some bit of a sensible and other sites, right? So I just wanted to acknowledge what they had built, mainly from the copyright perspective. I think that's all. Those are all the few things. And so a bit about me. I know most of you or none of you saw me so far, and I will probably come on video a little later. But I've been working in IT for more than 2 decades, and I have a couple of passions other than trading. I read quite a bit. These are all my book collections, and I also play badminton at corporate level, and I am also certified yoga teacher, and I do painting as a hobby, and I did win a couple of state level prizes, mainly in Andhra Pradesh, before the bifurcation happened. And right now, still I do painting. Actually, you can see my one of my painting this side, which is unfinished. I think those are all a couple of my hobbies, and I do still work in IT, and I'm a full-time IT employee right now. But then eventually, I wanted to I'm ready to retire anytime. But let's see how the things would shape up. Irrespective whether I take the trading as a full-time profession or not, but I'm sure most of you would have heard about this FIRE thing, right? Which is financially independent and retire early. So that is the stage I'm in right now. So when the things work out, I will look at retiring and then do pick up my passions, not just trading, but also, as I said, painting, badminton, fitness, any of those things, and maybe writing some books. All right, I think that's the thing about me, and I will, as I said, I will probably come on video when the time permits, and uh, yeah, file number I'll not for today, but then I'll definitely talk about that when the time comes, but not for today's session. All right. So I think probably most of you may not be interested in my personal life, but then this is what which is maybe you are interested, right? So as you can see, in fact, I have been trading from 2020 January 30th to be precise. I tried to pull the data from Jiroda, but unfortunately, it API got timed out, so I couldn't really pull that. But I did pull up for last 1 year. So as you can see, the top is most of my trading activities, and then below are my profits and losses. And overall, I'm profitable starting from 2022, I think 21 or 22. So last year has been good, and this year has been tremendous. So that's what the trading journey. And I mean, obviously, I did get into some losses, and but that's part of the job. So as of now, as I said, I'm profitable, and then my approach of looking at the profits is I do not really look at the day to day, but then in a month, if I'm profitable, I do consider that as a profit making month. That's how I really look at. So I again repeat, I have been trading from 2020 January 30th. I think that's the date, and it was actually just before COVID, and I've been trading pretty much daily. Either it is either one trade or 10 trades or 100 trades, it doesn't matter. But then I've been trading. I never missed a date from that time. And also, one thing that I wanted to tell you is a lot of times you get to hear saying that, hey, do not trade on particular day, do not only do when the setup works or whatever, right? I think I did a bit of a reverse. I traded every day. It could be budget day, it could be election day, it could be bank policy day, any day, really doesn't matter. So my belief is if you're not ready for those challenging days, there will not be any easy days you'll be able to make money, right? So that's the thinking. Again, the advice is to not to follow what I'm doing, but then this is what which I do. All right, so one second. Okay, I'll also get onto full mode so that so I did remove the chart there, and you will also not to see. Yeah, all right, so this is a full screen now. All right, so this is what which I'm going to cover today. The first is definitely I'll start with the basics of options. Maybe some of you would have approached options in a different way, and I think it's important for us to get back to basics. That's very important. Also, I'll also touch upon how the call and put options work, And then I will talk about the seller's edge. Maybe you would have heard about this earlier, but I wanted to cover. And finally, I will cover some of the strategies that you use for positional trades and also expiry trades. And some of you asked, especially for expiry trades, how do you really manage the spikes? And also, there is a lot of volatility that day. Some of the strategies that I'm going to really talk about these trades as well. So I think that's the main agenda for today. And today, I'm not going to cover anything on the option Greeks or any of those strategies, because that would require some bit of a advanced thinking. That's the reason. So I will not cover them, but I think my view, all these topics would really take us to close to 1.5 hours, 2 hours, depending on the questions that you may have. I think that's the main agenda for today. And if you want anything specific, do put in the comments. I'll keep watching the comments. But main focus is to really touch upon these topics at this point of time. All right. So before that, let me talk about trading strategy, right? So there is a difference between a strategy and then the skill. Let me talk about that. Trading, as you know, it's basically buying and selling. This is the definition that I got from Collins. But ideally, if you want to make money, what you would do, you would buy low and then sell high. There is no rocket science there. Or otherwise, you sell high and then buy low if you're on the other side. Only these are the only two ways to make money. There is no other way to make money from the trading, even in the trading that we do in the options or whatever, right? So you have to buy an option and then sell high, or if you're selling an option, you would sell high and then buy low. That's all. That's the no rocket science there. And then let's also look at the strategy. The strategy is very important. I personally believe a strategy is different compared to a skill. Strategy is basically you have to plan, and then you need to get an advantage of how to achieve success, and then it got to be a repeatable success. It shouldn't happen that one day you make money, second day you absolutely lose everything, and third day you make money, and the fourth day you lose everything. I think that is not a strategy. That would still be called as gambling. So and gambling also needs some skill set, but obviously strategy also needs some skills. But then the strategy, as I said, right, it got to be absolutely there are three properties here, so that it's very clear to you. So there got to be plan, there got to be edge, there got to be long period. So edge is advantage here. That's what which I picked up. So just remember these three words. If none of you were thinking or the way of doing the trading doesn't fall under these three, you should consider that as more of a gambling. As I said, there got to be a plan. You also need to find an edge, and it got to be sustainable for long time. So those are all the good things for you to learn from the strategy perspective. So even if you're buying or selling, I'll again repeat this, right? There got to be some plan when you want to buy, when you want to sell, and you need to also find out your edge. Your edge got to be definitely better than your competitor. Your competitor in this case, if you're a buyer, your competitor is seller. If you're a seller, your competitor is buyer. That's all. Only one competitor that you have. So you need to find an edge there, and then you should be able to sustain long period. When I say long period, I'm not expecting you to do trading lifelong. At least next 10-20 years, your strategy should really work. I think that's what a long period. It shouldn't happen that you come to market with some capital and then you would actually adjust entire capital and then exit the market. That is not the way which you'll have to do trading. All right. So I think most of you would know these things, but I think just for the completeness of this session, I want to really cover this. Right? What is derivative? Derivative is always an underlying asset. Underlying asset in this case is basically either in the stocks or the index or the group of assets it says. So in India, we got pretty much all the 5 indices, right? So you have the in fact, Monday to Saturday, you have mid-cap Nifty. I'm talking about the expiry is Fin Nifty on Tuesday, and then Nifty on Wednesday. Sorry, apologies. Bank Nifty on Wednesday, and then Nifty on Thursday, and then Sensex is on Friday, and also Bank X also we have on Monday. Those are all the indices, and obviously Nifty and Sensex are a lot more famous compared to other indices. Again, to go back to the basics, Nifty index started back in 1995, and it gave a pretty much returns of about 11.83% so far. If somebody doesn't want to really think how the market works or whatever, they can just put into Nifty Bs and then just leave it there. It's up to them. However, I think the constituents of Nifty are important, right? So HDFC Bank is at about 11%, Reliance is about 9%. The reason these are all important, mainly because in case if there is, let me go back to, yeah, in case if there is any issue or the challenge with the index, you can always come back and then see which stock is actually pulling up or pulling down. So that's the very reason you need to know these indices, or the what are actually part of the index. That's all. This is, as I said, this is mainly for the academic purpose, and very similar to Nifty 50. Sensex got about 30 stocks, and I think other Bank Nifty about 12, I think, and so on and so forth. All right, so we have mainly three types of derivatives, and the first is futures. In fact, before futures, it is called forwards. Forwards, we do not do. I don't think I hear anything doing in India. Forward is very similar to futures, just that it is actually done outside of exchange. That's all. That's the only difference. But futures are most widely popular, and also futures are widely used in the exchange. Today, I'm not going to cover futures, except when I get into covered call, I will show an example, because I can't really show stock as an example there. But otherwise, the only difference in the futures and stocks is futures have an expiry. In India, we got about 3 months of expiry. And instead of buying one single stock, you can buy lots of stocks. When I say lots, it could be, let's say, TCS, it could be 175, or Infi, it could be 400. And instead of buying one single stock, you buy futures, and then you get a margin advantage. Instead of spending all the 9 lakhs or 10 lakhs, you would probably end up spending about 2 lakhs or less than that. That's the only advantage with the futures. But today I'm not going to cover futures, but predominantly I'll get onto the options. So options, again, from the definition perspective, it is important for you to know. So it is actually a contract between the buyer and seller, and then it does give a right, but not an obligation, which means that you have right to execute, but there is no obligation to execute. You can always exit the trade before it gets expired. So that's what which it means. And I'm getting into options in a pure play academic perspective, right? Because unless you know this concept, it's very difficult for you to decide whether you want to do a buy option or a call option, or a buy option or a sell option, or a call or put or whatever. So that's the main interest there. And then, as I said, it gives a right, but not an obligation. And then yeah, typically buyer of an option pays a premium, and then the seller of a option gets a premium. That's how it happens. But let's get on to call option, put option, right? So I think most of you, if you're trading, simply what you do is when a stock price or index is going up, you would buy a option, and when it is going down, when it is going up, you buy a call option. When it is going down, you buy a put option, and vice versa. If you're a seller, when it is market is going up, you sell a put option. When the market is falling down, you sell a call option. That's how you actually take it. But then pure play academic perspective, this is what it is, right? So it gives a call option, gives a buyer a right to buy underlying asset, especially when you do stock options. This is very important to know. And put option gives a buyer a right to sell the underlying asset. I will in fact spend about 10-15 minutes to get into stock options and then get back to index. The only difference between index and the stock is, stocks you'll have to take a delivery in case if you do not close any of these options. But index, there is nothing to take delivery, right? So they will, index options pretty much expire worthless if the price really doesn't fall under whatever we are predicting. Those are the differences. Okay, I'm taking TCS as an example. So TCS, any of you own TCS stocks, by the way? I just a question to, you can say yes or no, that's all. No need to tell how many stocks you got. Can you put in chart? One in fee, okay. All right, no problem. TCS I have been owning for pretty much from the IPO. It's quite a good company, but anyway, not a recommendation, but just I thought I'll let you know. All right, so anyway, let's come back to TCS, right? So so there are two ways. So I will in fact talk from the call perspective, and also I'll talk from the put perspective. That's important. So in this case, one second. All right. So in this case, so what happens is when it comes to call option, it gives a buyer right to buy a call option underlying asset. That's what it means. So in this case, when there's somebody doing a call option, right, the assumption is seller of the call option is having TCS shares. So this is an assumption. The person actually buyer is not holding any TCS shares, but the seller is holding the TCS shares. That's the basic assumption here. Let me go one by one, right? So just remember, here seller is owning TCS shares, buyer doesn't have the TCS shares. Now let's look at, in fact, this is very important when you get into covered call, when I'm going to cover that covered call concept. So just follow this carefully. So current price of TCS is about 4,220, and the seller predicts that the price will not go beyond or above 4,300 by 29th August, which is the expiry day this particular month. However, the buyer predicts that the price will go above 4,300. That's where the same date, which is the same expiry date. That's how the buyer thinks. But when it comes to seller, seller sells a call option. In this case, because seller is also holding, just for the agreement, just for the argument, just think that the seller is having about 175 shares. So now seller in fact sells call option at 4,300, and currently the premium is about 40 rupees per share. Because the lot size is about 175, and the seller actually makes about 40 multiplied by 175, which is about 7,000 rupees. So that's how the seller takes a premium. But when it comes to buyer buys the call option, obviously from the same seller, and then the price is at about same. This is called strike price. 40 rupees the premium the seller pays, and the total is about 7,000. So that's what it is. And 7,000 40 multiplied by 175. So this is the 40 is the premium, and 175 is the lot size. If any of you are getting confused why 175 versus instead of 1. And stock options are always sold in the lots, not necessarily a single one. The lowest lot I saw was for is about 10 lots. Any guesses which stock is it? One stock got just 10 lots. Okay, MRF is right answer. Okay, great stuff. MRF is right answer. All right. So let's now when it comes to 29th August, there are multiple things happen. But let's say if the price stays at 4,300 or below 4,300, seller keeps the shares and also gains a profit of 7,000. This is a pure play covered call, but as I said, I will also touch upon covered call little later. In this case, seller obviously makes money, which is about 7,000, but buyer loses that money, which is 7,000. That is one case, right? So in this particular scenario, TCS share price got expired below 4,300. But there can be other scenario also. If the TCS price goes above 4,300, ideal case, what would happen is, as I said, this is a theory, but in reality, it would be a little different. So the theory is, in this case, even the price goes to 4,500. When the price goes to 4,500, seller has to sell the TCS shares at the same price instead of 4,300 or whatever. So my bad. I think it's 1 second. Just give me 1 second. All right, I think that's right. Okay. So in this case, what would happen is the seller loses close to 28,000. The reason is in fact, this is actually 4,300, not 5,000. Let me change that. All right, I think this way it is better. All right. So in this case, those are prices at 4,500. Seller still has to sell at 4,300, which means that technically it's about 200 rupees loss. But however, because the seller already got a premium of about 40, so he or she would make about lose about 160 rupees. But in reality, what would happen is a lot of times sellers would actually, or anybody, right, they would close these deals on the one day before the expiry day, or on the expiry day before 3:30 or whatever. So a lot of times the delivery wouldn't happen, but then they would just lose this money, 28,000, and then leave the deal that point of time. So I think that's how it happens. So especially if you're doing stock options, you need to absolutely remember to uh, close those contracts before the expiry date, so that you will not really get into delivery. There is nothing wrong in getting into delivery. Some people also are okay to get into delivery by taking the losses, etc. But it's up to you. So put option, I'm not getting into too many details, but it works very similar to call option. But then the only difference is, in this particular scenario, the buyer holds the shares, not the seller. That's the only difference. I'll quickly run this through. I still want to cover this. The reason is, a lot of times we are not very sure what it means to a put option or the call option, right? So as I said, if any of you are just doing index or indices options, you will only know that when the index goes up, you will make money with the call option, or when index goes down, you'll make money with the put option. But then there's a lot of theory behind this particular thing. So that's the reason I thought I will quickly cover. So you can actually run this through when you get time. I'm not covering this for now, the put option side, because it works absolutely similar to call option, except in this put option case, the buyer will have the TCS shares, and then whenever there is a up movement or the down movement, that's where the people would execute those contracts. All right. So now, most important thing, let me really talk about a bit around the options trading, mainly from the indices perspective. So before I go ahead, let me look at how the option price is calculated, right? So there is only one formula which is universally done, which was invented by a person called, okay, I'll take a pause. Enough, who has invented option pricing? He actually got a Nobel Prize. A hint. Yeah, Black-Scholes is the right answer. Very good. Yeah, they got a Nobel Prize for this particular invention, and I think somebody famously said that I think everybody in Harvard school or Harvard University, right? They do understand how the option price is calculated. So, but I'll try to make this very simple. Option price, in fact, very complicated. If you really go on and Google, maybe I'll open that very quickly. I thought I'll write here, but then it will be quite overwhelming for some of you. Give me a few seconds. All right. So I will change the screen. I assume you're able to see my screen. So, all right. So this is the formula, which is quite difficult here, right? So you have the obviously call option price here, and you have what is the current stock, which are the underlying. In this case, it could be Nifty or let's say TCS or Infosys or whatever. And then it also has a strike price, which is K, and then you have the risk-free investment rate. This is basically if you have to put your money into, let's say, FD or any of the debt funds, what kind of interest rate that you will get, and also what is the time to maturity, and then the normal distribution. Those are all this is the formula. But I know this formula is quite overwhelming, and good that he got a Nobel Prize for this particular formula. That's very important. I try to make this formula very simple, and let me go back to my PPT right now. All right. So, so I try to make this formula very simple, right? So there is premium is equivalent to intrinsic value. Intrinsic value is predominantly the underlying value, and then the time value. That's all. And then intrinsic value, it got the combination of your volatility, and then the current price and other things. But right now, you just take it as your stock price, and then bit around the volatility. Again, how the lot of events happen around us, depending on the price would change. I would assume most of you would have seen, right, before the elections or during the elections time, the VIX has increased, and also budget time VIX has increased. All those things would really get into volatility. VIX itself is not a volatility, to be precise. VIX is in fact calculated based on the premium prices, but then internal volatility, depending on the how the economic situation or the world around us, really look at some of these things. So that's important. And then there is a time value. Time value is basically, as the time approaches to the expiry date, the value of the premiums would decrease. So now this is a very important slide, right? So option seller has an advantage of both intrinsic value and time value, but the option buyer will have only intrinsic value. So this is the reason people say this is a time decay or theta from the Greeks perspective. But then this is the inherent advantage of the options seller compared to an option buyer. So that's the if I have to, I think most of you would have heard about the probability, right? So this itself, if you have to take this entire thing as, let's say, 100% probability, right? So option seller walks away with the 66% probability of success, versus option buyer will have a 33% of success. So again, I'm not saying that only option sellers make money; they also lose money if they do not do a good job. But the odds of option buyer making money is only 33%, versus odds of option seller making money is close to 66%. So that's one reason I did start doing option selling from the pretty much from the day one. I did I think one or two option I think stock options I bought one or two, but then I when I did, I do not know that there is a time value. I ended up losing some money, and then initial days itself I realized that option buying is not my cup of cake and cup of tea or whatever. So that's the reason I pretty much moved to option selling rather. So any questions on this? I think this is very straightforward. If you're any of you are doing option selling and buying, I don't think I need to really get into a lot of explanation here. But then I just want to repeat, the odds of option selling is about 66% becoming successful, and versus a buyer is basically 33%. That's all right. So I think this also most of you would know what is in the money and then out of the money, because these words I would use quite frequently when I get into strategies. That's the reason I thought I will quickly get it through, right? So ITM, when the strike price is lower than the spot price, for example, if you take Nifty currently is trading at about 24, I think 380 or whatever, and anything below that is called in the money. And when it comes to put option, it's the other way. And if you're actually buying or selling an option higher than this particular number, 24,300, let's say 24,500, that is called in the money for put, but it's less in the call option side. That's all. That's the main difference. When it comes to out of the money, it's absolutely opposite. Call out of the money would be strike price is higher than the spot price, and then the put is absolute opposite way. That is out of the money. And then there is ATM, at the money. At the money is typically the price that is traded, 50 points here and there. You will call it as at the money. I think that's those are all the three different things. I again repeat, there is an in the money, there is out of the money, there is at the money, ATM. And OTM also, there is a for OTM. Usually your hedges would be for OTM mostly. I think those are all the three differentiations that you should be able to really make. All right, before you start trading, I think all of us need to have some bit of a mindset and thinking, right? So I thought I'll quickly cover these things as well. Just give me a few seconds. I'm just checking. All right. So before you start trading, there are a couple of things that all of us need to do. The first is before you want to become a full-time trader, I know this could be a bit of a anti-climax to some of you if you wanted to make trading as a full-time career, but then I just want to be very honest and then open. Always have a fixed source of income. That could be your job, or it could be any other business or whatever. Do not make trading as the only source. Again, fixed source of income, it could be your stocks as well. Let's say if you have a good portfolio about, let's say, 2-3 crores or 5 crores or whatever, you can always get the money from the stock appreciation and also from the dividends. I think that is definitely a good way to get the source of income. But if that is not the case, at least you should get some money from your job or the business or whatever. I think that's very important. The second one is, if you want to become a full-time trader, it's important for you to build some capital. And I will also talk about the capital I believe is going to be really useful for either option buyer or seller. That's very important. And third one is, you need to again build capital. There are multiple ways to do that, right? If you are a full-time employee, or if you're doing a job, it's always about doing some SIPs and mutual funds, or the uh, also the stocks, or otherwise, even if you wanted to really buy some nifty Bs or any of the bonds, etc., absolutely all right. But then the building capital is absolutely important. um, I'll again go back to the first one, right? I think most of you who are attending this session, I'm sure you are actually either running the families or somebody is dependent on you. You do not want to really mess up with the income and then impact the people who are dependent on you. That's very important. If somebody is selling a dream saying that you can make thousands, crores, or millions from the stock trading alone, I think maybe possible. The chances are 1 in a million, or I would say 1 in a billion. Personally, I did not see anybody making lots of money just from trading. So it's not just in India but across the world. Coming back to the third point, it is important to understand the market dynamics. When I say market dynamics, it's just not about the price action, right? Price action is a result of what is happening around us. While that is the truth, but then we also need to understand some bit around the macro and then microeconomics. For example, let's say when RBI changes the rate, what happens when US Fed Bank changes some rates, what would happen? Or when there are elections, what would happen? When there are budgets, what would happen? I think it's important for you to understand some of those basics. Fourth one is, you should be in a position to connect the dots. Connect the dots in the sense, let's say if something is happening in US versus, let's say there is a war in Israel, or there is a war between Russia and Ukraine, there is some unrest in Korea, or there is something happening in Taiwan, there is a China versus Taiwan, any of those things. I think if you are able to really look at how these international activities would impact the day-to-day stock trading or the your investment philosophy, I think you should be able to really connect the dots. So in fact, the fourth one is very important. The reason is, a lot of times when you start the trading, you tend to get into understanding. I mean, a lot of people get into telegram channels and then simply buy and then sell what some person says. They're saying because they're not they do not want to take risk, or probably they would not want to take risk, right? They wanted you to take the risk. So obviously they get money for selling those tips, but I wouldn't suggest you to do that ever. I think you should build your own knowledge, your own confidence, and then once you are ready, then you should really get into this particular activity. Otherwise you will end up losing money. I can tell you hundreds and thousands of people who are part of those groups, and then they just get some tips, and then they probably initial 1 or 2 days they'll get money, but the third or fourth day they will lose entire money. That's what which a lot of people told me. I personally did not do any time, but then a lot of people ended up losing money there. So final one is very important: to build your own thinking process. You listen everything, you hear everybody, you look at all the suggestions, but then you should have your own thinking process to build anything there. Otherwise you will tomorrow, let's say if somebody who is giving a suggestion to you, if the person is not around, you will not be able to do anything. So that is fifth is absolutely important. And then becoming rich is a slow process and it takes many years. And you might also quote 1 or 2 people who made 1 crore or 2 crores in options in a day. Possible, I'm not denying that, but then as I said, the percentage is 1 in a million. Not everybody can make that. But when the odds are so less, it's very important for you to do what is going to work for long term. So that's what which I believe. All right. This is no indication, but then if you're a seller, I would expect at least to 25 lakhs capital. Below that, I would not even suggest you to really get into option selling. Also, these 25 lakhs, you would not put everything into one day, right? Or even if you're doing day trading, you will start only with 10 lakhs, and then the remaining 15 lakhs you will use for adjustments. And if you're doing positional trades, you might probably do 12 lakhs and the remaining 50% you will use for adjustments. You would not really put every capital, every last penny into the trade. If you do that, what would happen is you would end up losing money when the market actually acts against you. Because again, personal, I believe nobody can predict what's going to happen tomorrow or what's going to happen next 1 hour, right? So it is always good to have that kind of a backup, so that you will, again, whatever I'm saying is a strategy. It's not a skill, right? So strategy, as I said, it needs to have a plan. It needs to have bit of a logic behind it, and then it also need to sustain bit of a long term. So that's the only reason I'm saying all these things. Now, a quick question: if you are a buyer, what kind of capital that you think you should have? Any of you can respond there. This question is especially for buyers. All right, so let me show some of these answers and then it matches to. All right, so I think you will be a bit surprised with my response here. So, in fact, buyers should have more capital compared to this. This might look like a anticlimax. The reason is, if you do not have a proper capital as a buyer, you will end up closing the shop. It's a matter of 1 or 2 weeks or 1 month. That's all. So ideally, I would expect you to have at least 1 crore portfolio, and then maybe you should have at least 10 lakhs cash. And the 10 lakhs cash is something that you'll have to use for buying. Again, the buying, mostly I would expect you to do mostly for the hedging, not necessarily for going in and making money. And that's very important. So if you do not have this kind of a portfolio, I would not expect you to become a buyer. The reason is, I know a lot of times, if you get into any YouTube channel or the Telegram groups, right, people say that, okay, bring about 10 lakhs and then we'll make you become 1 crore in a month or 2 months. So that's absolutely not possible. You will, I think, a lot of times you will end up losing money. The reason is, again, there could be some beginner's luck. You would probably gain in 1 or 2 days or maybe 1 week. I mean, I had seen people gaining even, let's say, 1 month, and then the second month they would lose everything, and then their entire capital becomes zero. There are a lot of cases like that. So do not get into at least the neck buying, right? So when I say neck buying, it's basically you would not have any hedge or anything, so you just go and then buy, assuming that the market is going to go up. Obviously, you would buy you would buy a call option and then wait for miracles to happen, and that wouldn't really happen. If you're trying to do make a lot of money from the buying, as I said, the odds are absolutely low. In fact, the starting itself, you got only 33% odds, and then on top of that, if your predictions are wrong and then if something happens, you would end up losing money. So that's the reason I personally, again, I'm not saying that you should not do buying. You should definitely do. I also do buying sometimes, but that is mainly for the hedging perspective, but nothing beyond that. As I said, this could be some bit of an anti-climax for some of you, but then that's the truth. I do not want any of you to lose money, simply your hard-earned money, right? So a lot of times you earn putting 8-10 hours and then simply you lose in 1 minute. That really doesn't make sense. All right. So let me now get into some bit of a positional trading strategies. These are all some things that I use, and if you're following me on YouTube, I did share a positional strategy. Okay, 1 second, I'll remove this. Hide this. All right. So I did share a positional strategy. I think I did in Angel One, if I remember correctly. But before I go with the positional strategies, these are all typical I would look at, right? So I would look at the open interest. I think most of you are aware what is open interest. If you want, I can explain, but open interest is a significant way to decide what kind of positional strategies that you do. And also you need to have a bit of a viewer on the future events. When I say future events, let's say if you're trying to do August 29th expiry, you need to really look at what are the events that are going to happen from now to then. Obviously, there would be some events where you can't predict anything, but then there are some planned events, for example, an RBI event or the Fed rate cut, or maybe a budget that is coming up. Some of those events that are already defined. So you just need to understand what are those future events. And overall trend you need to look at. I will in fact show you one of the indicator that I use quite often, which is linear regression. I'll talk about that in a model in a moment. And then finally, you also need to look at the probability model, which is quite important. We'll talk about the probability model also when it comes to positional trading. All right. So on that note, these are all my favorite strategies. I do covered call mainly for the positional trade, and the second one is triangles. Third is straddle. I also started doing something called Phoenix strategy, which I named myself. So that also is quite impactful. I will talk about that when the time permits. So first, what I'll do is I'll cover the positional strategies, and then after that I'll get on to expiry day trading. And also when I get into expiry trading, I'll also talk about some of the strategies that I use to tackle these sudden spikes. I mean, famously they called as injections. So I will see how do we really tackle some of those things. All right. Okay, let me get on to covered call, but before that I will take a 1 second. I will show you one of the indicator that I use quite often. All right. So I assume you're able to see my screen. Okay. So here you go. So this is one indicator that I use quite often, which is called a linear regression. In fact, you will find this in the trading view. Let me show this. All right, let me make it easy. So this is the linear regression. We're able to see, in fact, I used 144. You can also use 100. So below you got to see MACD, which is moving average, convergence and divergence, and you also have the RSI. RSI is, I think most of you know, relative strength index. I'm not getting into how these indicators work. MACD is typically the difference between long moving average and short moving average, and then it will give you some good sense. But let's say if you're getting into positional strategy, this is how I would approach. Again, this may not be the world's best approach, but this is what which works for me. So this is the August 29th date. You can see the vertical line here, August 29th date, and then this is the Nifty, and then you also got to see some number here, which is 0.9913. If any of you are familiar with the data science, so this is basically the, I think it's called Pearson value. You can give a Google what is Pearson value, and this is basically brings a number which is a correlation between all these values, how well they are correlated, which also indirectly means it is a high probability. So if technically it says that, okay, this particular thing has a correlation of about 91%, which means that there is a 91% probability that Nifty would actually fall between these two when it comes to August 29th. And also if you change these, let's say if I go to 1 hour, it says 0.34, which is obviously less probability. And then if I go to, let's say, 1 week, let me show you very quickly, and it's 94. So we can either stay here or we can get on to 1 day chart. All right. In fact, this you can do for other stocks as well. You can do for Nifty, TCS, whatever you believe is you're going to do a trade. So now, so this is the most probable line, right? So the red line you see, this is what which is a prediction, and then if you're familiar with standard deviation, this is actually two standard deviation. This is on the upper side, this is on the lower side. So what it suggests is Nifty there is a 91% probability or 91% correlation that it is going to end at 25,000 by August 29th. That is what it is showing. And it also shows that the lower side, when it comes to 2 sigma, this can probably end at about 24,275, and the top side is about 25,841. And that's what it it says from the data perspective. So now let's say if you're trying to do a triangle or even a covered call, right? So you have multiple options. So Nifty, or let's say if you're doing INFI or whatever, let's take TCS for example. So now TCS, again, it's 48%, not so great probability, but let's look at another probability. It's 62. And then I got, I mean, typically when I'm doing monthly, I would use more than hour, because that gives, okay, let's take it as 3 hours, right? So, but 3 hours is mostly may not be possible, but right now let's go with 1 day for now. 1 day it says 50% probability, but still it's okay. And you go to, let's say, 29th August and then see where it might fall, somewhere here. And it says top is about 4.4, and then the bottom is about 3.8, and then you might want to go on and do a triangle there. And then obviously need to do adjustments as the time progresses. So let me go back to Nifty now. So positional trade, typically what I do is if I'm doing a triangle starting of the month, I will look at what is this position, and then do that. But only one trick that I want to tell you, let's say when it is in the top layer, right, very close to this one, there is a high probability that this may not probably go up, but then it might actually fall down, or it might actually stay flat there. Because if you take this date, which is August 1st, which is predominantly all-time high, so from the all-time high again getting into all-time high, the probability is very low. So that is one reason that you would not want to really go on and take a trade here, right? You might probably want to bit come down, but then when you're coming down, you would not really go with a full-blown quantity. What I meant is, let's say if you're doing 5 lots of CE, you may want to do more lots in the PE side, or vice versa also, depending on your direction, etc. I think that is one thing that you need to really remember. You also need to look at where the index is. The index in this particular scenario is above this red line, which means that the probability of this going up is quite low. And also when it is below this, probability of this going even below is quite low. So I think some of those things that you need to really look at when it comes to position side. And when it comes to strangle, it's not required for you to always go with the equal quantity. Some could be higher, some could be lower. That is the call that as a person that you need to take. I think this is the one indicator that again, there is no foolproof way to in the world, right? So this indicator, if it is 100% accurate, everybody will make money. Unfortunately, that's not true. Any of the indicators that you see in the charts, they are close to 70 to 80% accurate, and the remaining 20 to 30% is always your intuition and then bit around the luck. That's how these indicators would work. And also you got to see this MACD and other things. So right now MACD is actually, the bearishness is actually in the reversing mode. As you can see here, the red is actually turning into white. So this will give a good sense saying that probably market is actually turning from bearish to bullish starting from August 1st or whatever the date. And depending on these, you should take a call. And also here RSI, if you take, it is not oversold. 40 is also not oversold. At least 30 to 20 you can consider it as oversold, but right now it is not oversold. It's somewhere in the mid range. You can say that okay, this is going to be flattish day, and then you can go and then take your strategies there. I think that's that one indicator that I wanted to really share across to all of you. So I think Himanshu asked, how is the starting point of regression picked? So regression model, what happens is it is automatically picked. As I said here, you can choose how many days you want to go back, how many points you want to go back. So here you see 100. You can also do 144, or you can do, if I do 144, then values would definitely change. Again, there is nothing like 144 is more accurate than 100. There is nothing like that. So in this case, it is 90. You can also do 200 if you wish to. All right, so 200 here, 94. So you can stay wherever you want, but then obviously this range will change drastically. So my suggestion is, there is do not follow because I put it 100, right? So you do trial and error and then see what works for you. And any indicator that you take, always trust them only 80%. The remaining 20%, as I said, it's your intuition and also bit around the luck. So that we can't help much. So I think that's about. So somebody said that please check for Infi. I can always do that. Let's do Infi. All right. So Infi daily chart, it's about 70% accurate. And then if I go to, let's say, August 29th here, so the most probable it says 1770, and then the highest it says about 1967, bottom it says about 1565. So you can technically do a triangle and then keep right there. I hope it will work, but again, that's not a suggestion, but you need to use your own analysis. All right, so let me go back to the PPT again. Any questions on this particular indicator? Because I excessively use this indicator. Um, Basically, the stock didn't obey the two. Yeah, so there could be some occasions. I think somebody asked this question. Right? The stock didn't obey the two sigma, and no, most of the times, two sigma is basically a very high probability thing, right? So most of the time, stocks would stay between them. And in case if it breaks either the two sigma bottom or the top, you can take it as a breakout or the breakdown, so whatever. And then depending on that, you'll have to either do an exit or entry, any of those things you should do. All right, I think no questions, thank you. Okay, great stuff. So let me go back to the PPT again. All right, so now let's come back to the covered call. So covered call is basically, it's when you have large number of stocks, let's say Infosys or TCS or maybe MRF or any of these stocks, right? So what you do is you would sell a uh, call option. So that's covered call. So here, this I picked up in Info as an example. And just for this particular example, I picked up a future because I can't demonstrate stocks here, right? So in this particular case, in fact, I can log into Sensible and then also show this multiple variations. So let me do that. Sensible probably is easier rather than PPT. Let me go back to uh, my screen again. All right. So let's start from the basics, right? So covered call, the way which it works is, let's imagine that you have infi. Let me do infi here. So I would actually think that you have, I think now the infi lot size is about 400. I think that's what I remember. And you have this many infi stocks, 400 stocks. You can also multiply 400 stocks. There is no brainer. If let's say you bought it for 1772, the current price, if it goes to 1800, you will make about 12,000. And if it goes to 1860, we'll make about 35,000. So I'm assuming that you got so many stocks. Now, let's say why somebody does a covered call. So usually what happens is markets, they have only three paths, right? So it will either go up or go down or stay flat. Again, uh, there is a one-third probability that it's going to go down, two-thirds probability that it's either going to stay flat or go up, or maybe I'll change it reverse, right? So there is a one-third probability that it's going to go up. There is two-third probability that either it is go down or stay flat. One of those things would happen. So now with the 66% probability, now what you would actually do is you go and then sell a call option. So your call option, typically right now the stock price is about 1770, right? So you go on and sell a call option, let's say 1800. So the assumption that you are making is Infosys will not cross 1800 rupees. That's the assumption that you are making. And I'll come back to linear regression. Just listen to this covered call and then I'll go back there. So Now let's say that is the assumption that you're making, right? Even if, let's say, if it goes above this, you're not going to lose anything. The reason is it's going to be flat. The only one disadvantage is, let's say Infosys goes to 1850, you would only lose the profit. You are not getting into any losses. The reason is you are actually gaining on the stocks, but you are losing on the options. Obviously, you will not wait till here. As soon as it reaches here, I would expect you to probably exit the stocks and exit options. That's where you will actually minimize your losses. Sometimes what happens is people, in fact, when they do covered call, they just assume the loss on the options, but then they would let these stocks to also go up. The only disadvantage with this is, let's say it touches here, you exited the call option with obviously loss or whatever, right? So, or maybe net zero, or maybe here, let's take this as an example, right? You lost some money, but then the moment if the stock really falls from here, you would also lose on the stock. An ideal scenario is you would exit the option, you would also exit the relevant stock numbers, let's say 400 in this particular scenario. That way you will not be able to really get into too much of a loss. So that's the main intention of doing the covered call. So any questions on the covered call before I get on to linear regression again? I think a lot of questions on the linear regression. Yeah, any questions on the covered call? Okay, no questions. That's great. So let me again go back to linear regression. That seems to be more popular. All right. So let me. Any of you have any favorite stock or index? Let me do mid cap Nifty, which is Monday expiry. Will that work? All right. Let me do mid cap Nifty now. All right. So mid cap Nifty. Monday's expiry. Obviously, if it is just one day, I would not really go with the day chart, right? So it got to be definitely less than that. 1 second. So it needs to be at least 15 minutes chart. So 15 minutes is actually shows about 83%. As you can see here, right, these lines were drawn automatically. I did not do anything. And if I change from, let's say, 15 to let's say 10 minutes, the lines are also automatically drawn, but then it actually takes last 100 occurrences. That's the only difference. Let's take 15 minutes chart, and then Monday, let me draw one vertical line here. Monday. Okay, all right. So what it says is there is a 83% probability that the mid cap Nifty would expire below 18,855, and then it will expire above 12,857 and above 12,633, and then the most probable is about 12,745. That's the thing now. But then the one challenge that you would face is when the market opens, right, on the day Monday, let's say if it is so much of a gap down, some of these numbers would change. Then you'll have to find out what would be the more accurate the day morning. So the day morning you go and then see whether they were 10 minutes is giving more accuracy, or 15 minutes is giving more accuracy, or 5 minutes is giving more accuracy, one of those. And usually when it is below 0.5%, you should not really believe that correlation, because it is a very flat one. It is not able to find any pattern there. You can leave it there. But anything that is above 0.5%, that is what you need to really pick up. And then ideally you should have to do this on Monday morning, mainly if you're doing an expiry trade. But for positional trade, there is no rocket science. Positional trade, as I said, ideally you should look at one day and then see how this particular thing would actually shape up. If somebody wants to really forecast what's going to happen to mid cap Nifty by, let's say, December end or whatever, if somebody is, I think probably I'll pick up Nifty. Somebody is more curious to know what is going to happen to Nifty by December, and they can go back to here and then say this actually suggesting 28,000, and then bottom is about 26,000 with a probability of 91%. There is always a 10% chance that this will not be met. That somebody has to really take into consideration. But as I said, as the time progresses, some of these values would also change. Some of the forecasting will also change. So that's where you will actually go and then adjust the things. I think that's about the linear regression. Uh, you Okay, so I have a trading view premium version, I think. So I pay close to that 40,000 rupees per year. Maybe that could be the reason, but check if you have that indicator or not. So yeah, as I said, Pearson value. In fact, you can see here. Let me also show that. So this is where show Pearson R. So this is the value that I was referring earlier. So ideally you should have this value if you're not able to get this value. And also this is the upper deviation. You can also change to 1. It's up to you. And you can also, if you want to be a lot more closure, you can also do that. And this values would change drastically. So but right now I am comfortable with 2%. So two standard deviation. All right, then I think with the downtrend stocks, any stocks that you guys can think of? Yeah, so here you have gold here. No, it's Shopify. It's US stock, not India stock. This shows a downtrend. But let me look at IRFC. No, I think all Indian stocks are absolutely going up. Sensex Bank Nifty. Okay, I can't find any Indian stock which is going down unless you guys find something. But I think this is something that I can see close here. So this is the downward trend, and let me look at 1 week here. Yeah, 1 week is uptrend, but the 1 day is downtrend. So that's all. Rajesh, okay, Birla Soft. Somebody suggesting Birla Soft. Let's look at Birla Soft. Yeah, this is Birla Soft. Again, there is not much of a correlation here. It's just 26% correlation. So we do not know whether it's going to really sustain. I think RSI is pretty much in the oversold region, and I see some bit of a revival from the MACD perspective. I hope it will revive. I own Birla Soft stocks anyway. But then interesting, Birla Soft has been my multi-bagger mainly because I did buy very close to this place during the COVID time. In fact, even before this, I think, yeah, somewhere here I bought. So that is about 170 rupees or whatever. So I still own some of these stocks. All right. So I think that's Birla Soft. And let me come back to PPT again. All right. So this is the covered call, right? So I did covered call. So one more thing that I usually do is positional strangles. I don't think I need to explain strangles to all of you or any of you, right? So it's very straightforward. You sell a call option, sell a put option, and various very different strike prices, but the same expiration date. The only thing is if the expiry date is different, you get into calendar spreads, but same expiry date, it is very straightforward. So I think I'll probably talk about adjustments in a moment. And straddle is also very straightforward. If you have high IV and then the premiums are high, you would get into straddle. The only difference is this is the same strike price compared to any other thing. So that's what the straddle. I will get back to expiry day. Before that, I wanted to really touch upon a bit around the adjustments. I think that's very important. All right. So let me start with. In fact, I did some videos on adjustments, but let me do from the scratch. So what I'll do is I will start with the simple straddle. All right. So this is simple straddle. I'll take Nifty maybe. Okay, simple. This is called iron condor, but then it is a simple strangle without the hedges. So if I remove the hedges, it will become strangle. But if I have the hedges, it will become iron condor. So short iron condor. So this is the triangle, right? So probably I'll go a bit wider. So now let's go with the philosophy, right? So now let me go to, let's say if I have to do monthly triangle. This is nifty. So ideally, this says 91% probability, and then let's say just for the argument's sake, you go with 25. Probably 25 is too high. I'll probably stay here, which is 25 100, and then the bottom I will stay at 22,000, 24,230. So that's what which we'll do. Let me go here, and then so this is going to be 20. C is going to be 20. Sorry, apologies. 25,100, and then it picked up a. Sorry, I think it picked up. Let me start from the scratch. I should do for monthly. Okay, all right. So yeah, 29th, and then as I said, I'll do 25,100, and then I will do 24,200 P or 24,000 P just for the all right. So here what is happening is so the premiums are obviously not equal, right? So PU got more, and then C got more. So you can also do a bit of a adjustment here. So now it is 160, this is 55. You can, instead of buying 2, you can do 3. That is one way you will be able to really maximize your returns. This is, yeah, this now your premiums are equal pretty much both the sides. That's important. In case if, let's say, if there is a sudden fall, right, you will still have some cover because the P is very close. Now let's say this is a triangle. I will also buy some hedges. So hedges would be, in this case, because it's I'll probably do here, and then I will go here. Because it got 3 lots, I will also do 3 lots hedges here. All right. So this is a simple thing. So one thing that you need to know is this is not a equal thing, right? So, oh, nothing on C. Okay, sorry about that. Present, share screen, entire screen, share. What about now? All right. Okay. So you got to see now. So let me start from scratch. My bad. I did not really realize. Okay, so let me now okay, let me start with the this one, right? So the linear regression is very important. This is the basis for us to do a triangle at this point of time. So let me expand this a little bit. Okay, what it says is this month end, right? So which is 29th August. It says 25,879, and then the most probable is 25,070, and then the least probable is 24,674. That's what it says. All right. So now taking these numbers, I will go back to sensible in this particular scenario. So build a new strategy, and then let's say on the call side, I will take 25,000, let's say 100, and then the put side, I will take 24,000. I'll take this one. Okay, so now the thing is, it got 160 as a probable, sir, 160 as a premium price, and then 55 as a premium price. Now what happens is, in case if the market falls, your losses would be a lot more compared to your gains from the CE. The reason is you are pretty much very close to the this particular PE price. So typically what I do is I would actually get into equal premiums. So now 3 multiplied by 55 is close to 160. I think it's about 170, sorry, 165. And then this premium obviously stays pretty much same, nothing to change. So now I also would add some hedges. So hedges in this case, I will do hedges here, which is 3, and then I will also do hedges here, which are 1 here. Okay, so this is the strategy. Now what happens is, let's say in the worst case scenario, if the market falls, because you are very close to PE, your losses are definitely not so great, not so big actually. It's about 5,000 or whatever for a margin of about 69. But then obviously, if it is successful, you will get about 4,000, and then you are actually staying very far from this particular line. the probability of this moving from here to here is quite low. So, and also you can see here it says that 3.3%, and then bottom side is only is minus 2.3%, right? So that's the reason you had more number of calls here. The quantity is 3 versus this one, and you are actually managing your premiums pretty much equal. So this is one trick that I use, and it mostly works. And again, there is no 100% guarantee, but this is how you will be able to really do your strangles. So the only one important thing is this triangle is not equidistant. That's the first thing. The second one is it is also not equi-quantity. The lot sizes are very different. And yeah, it also covers in case if market falls, which goes against your view. I mean, it will definitely get into losses, but not unlimited losses. Versus, let's say if you do this also one, what would happen is if the market goes against your thinking, you get into 8,000 losses, which is obviously because this is very close to the falling down, right? So 8,000 versus if you get into 3 here, now your losses are little minimized. You will not get into, you will actually save about 3,000 losses there. That's all. So this is one thing that you can look at. And also probability of profit is about 65%. And then as I said, downside is minus 2.3 and upside is about 3.3. And the maximum profit you will get about 7%. Oh, somebody saying screen is not shared. Screen is shared now. All right. So if screen is not visible, can one of you say yes or no? I think screen is visible, but only one person is saying screen is not visible. All right. Now coming back to adjustment and stop losses, that is very important. So yeah, okay, yeah, you were able to see the screen. So stop losses, again, there is no rocket science, so it all goes with the risk appetite. Again, the way which I do is typically, because it's a monthly trade, I mean, some if I do some of these things, right? So technically, if you really look at the margin, I used about 69,000, and overall, typically I look at the overall PNL. If let's say my overall PNL hits about, let's say 10%, which is about 7,000. Then I would definitely exit. I do not want to really burn out money. Or again, it all goes with the risk appetite. Some people might say we can only do 5% loss, or some people would get into, let's say, even 3% loss. So one option for the stop loss is you can put it the overall PNL, not necessarily individual leg level. So that way, the reason is monthly options you have plenty of time. But if it is day trading, the situation is very different. But monthly options, what would happen is Nifty will go up, go down. You'll still have some money. You'll still have some time to really recover and other things, right? So ideally, I would personally, my suggestion is to put a stop loss at the overall PNL, not necessarily at individual leg level. And also one more reason is you also have covered your maximum losses, right? So it's not like end of the world, you would lose unlimited money. So putting a stop loss at PNL always be useful. Again, I'm not suggesting that you should put 10%, 20%. Depending on your risk appetite, you can always put. It's up to you. There is no nothing that you need to get into a prescribed number. It's absolutely up to you. And also sometimes what I also do is, let's say in a month I gained some money, right? So let's say I got, let's say 20,000 or maybe 1 lakh. So now I would put a stop loss saying that my overall PNL, if it reaches 50,000, I will quit. The reason is at least I'm left with another 50,000. That way, at least in the month, I will make some money instead of losing all the money. So again, some of the strategies you can absolutely deploy. But at the end of the day, you should really look at getting into net zero, not really getting into losses. But let's say back to back, if you have 2-3 losses, I would I would expect you to reduce your risk appetite, and then maybe put a stop loss at about 2%, and then exit whenever it happens. Again, that's my personal suggestion, but then you can always use your own thing. So that is one way to do that. The second way is you can also say in this particular scenario, right? I would typically put for PE about, let's say 25% to 30%, 33%. The reason is this is double my number, right? So I will put about 33%. But here I might go a bit overweight. So I might put 100% or maybe 60% or whatever, the stop loss. So in this case, what I meant is if 160 becomes, let's say 160 multiplied by 3%, which is at about 40 or 50 rupees, right? So 160 plus, let's say if it becomes 50, that is about 210 or 220. I want to exit this particular trade. The reason is I would have made some money on this, so I would exit this. But then when it comes to CE, I'm okay to go till 100 or whatever. The reason is I'm going to make some money here, but in CE, I'm going to lose less money. So that's the only reason. And also CE gives me some bit of an advantage of the time decay. The reason is by the time this moves from here to here, there is a lot of plenty of time. So the walking distance, you can think like that, right? So from here to going here, you will get a lot of time decay. So that's the reason CE, even if you put bit of a longer stop loss, the probability of that hitting is quite low. I know, I mean, ideally, if I explain this in the live market, you will be able to understand much more better. But then today markets are not open, so you will not be able to see much. But that is one strategy that you can do. It's not that you need to put 100% both the sides. So PE side you can reduce, and then the CE side you can always increase. And also depending on the market movement, you can always adjust the stop losses. All right. So do you always keep the system in stop losses? So positional trades, I mean, not much, but definitely day trading or the what do you say, the intraday definitely yes, but positional trades you can always skip. Okay, I think that's about that. And okay, so this is the triangle, right? So I think I did cover a bit around the adjustment, and also risk management is very important, either it is positional or the intraday, right? So you should not really blow up your capital. And if you have, let's say, 69, you should probably put about 5% or less than 10%, so that you are still left with about 90% of the money. But also, I think one more very important thing, right? If your capital, let's say you entered the market with, let's say, 50 lakhs, just for the argument's sake, and then you are losing consistently, and then you reached about 25 lakhs, you can safely assume that you are not meant for markets. You should quit. So because otherwise, if you're not able to really recover anything within the 50% margin, there is very, very low probability that you will recover. You will in fact make money with the remaining capital. That is the day that you need to sit yourself and then think, saying that this is not for you, and then you should completely quit. Maybe you would enter again once you gain about another 50 lakhs, another, let's say, 25 lakhs or 50 lakhs or whatever. But otherwise, I would not expect you to really blow up your entire capital. That's absolutely important. So how do you manage gap up or gap down with over 1%? See, as I said, that positional trades, if you're talking about the positional trades, there is nothing that you need to worry. I, in fact, had a positional trade in Angel 1. I will probably show that in a moment. I did not log in there right now. That's a real trade. At one point of time, while I made some money, it's a capital of about, I use very less capital there, about 27 lakhs. Or 23 lakhs, I think. I'm not able to recollect now. So 20, let's take it as 27 lakhs. So at one point of time, it went into close to 2.5 lakhs loss. But then I'm mostly sure that the reaction that happened on August 1st was more of a jerk reaction. So I did stayed on the trade with some bit of a coverage on the bottom side, which means that I would have probably bought more puts there, so that if the market falls, I'll not get into unlimited losses. And also on the C side, there is a good way to cover. So my view, again, if you go with the probability model, I'm going to show that in a moment, right? So it's not required for you to, usually markets, right, even the worst years or the worst case scenarios, markets are very rarely got into +5 and -5. So I think taking that into probability into consideration, you will be able to really adjust those. Yeah, so to answer Mahesh question, okay, let me put across his question here. Maybe I'll take a little bit of a pause and then answer some of the questions. Okay, so are the strikes selected based on the regression? Mostly yes, and also I also look at the open interest, so that's important. I did not show the open interest here. I would assume most of you are familiar, but I can also show open interest if you're interested. Yeah, if you take open interest and then go to 20, so there is a very heavy loaded call writing happened at 25,000. Again, not a big number, but then comparatively, there are also equally put. But then interestingly, there is no put after this, right? So this is one point. And then on the bottom side, you have pretty much 24,000. So ideally, it should really hover between these two. In case if it breaks, you have one more at 23,500. So open interest is also a uh, good way to really look at what's happening in the market. So yeah, so this I picked up this one. You can also look at next 3 weeks also, right? So you can combine these two and then see. So pretty much 25,000 looks very strong at this point of time on the upside. On the bottom side, you definitely have a good amount of support at 24,000. And as I said, if it breaks, you definitely get into this one. And also one more thing that you need to look at, right? So the PCR at this particular place is obviously put is high, and then this is low. And then from here, the PCR drastically changes. The percentage, the ratio between the put and call is drastically different here, right? So you can safely assume that this is a place where it's going to be a tipping point, and then the top side, this is a place where there's going to be a tipping point. That's all. All right. I think that's the linear regression for you. Maybe I think I will not open this one angel broking right now, but I'll do a separate video. You can have a look at it, how the adjustments are done there. But before I get on to the other one, I wanted to show this, right? So this is a program that I wrote some time back. If you are familiar with Python and Streamlight, this is what it is. And if any of you are interested, I can share the code. You just need to run it. It's very easy. So this is basically gives you a bit of a probabilistic model of doing the things. And I would assume most of you are familiar with the percentile concept, right? What it does is it doesn't work for mid cap nifty because there is no data, but then it works for bank nifty. And then mid cap nifty, I will probably do some scraping and then get the things set. But right now, let me explain this one. This is a very important one. Second, I'm not going to deploy, sorry. So what it does is, so if you take nifty, right? So these are all this table, if you're able to see this one, let me expand this table. So this is basically whatever is happening in the nifty for last 1 year. So, and then this actually shows what is from the open to high. The reason I picked up open to high, sometimes I tend to do only CU only. So that's the reason that is very important. So when I say CE only, I do just sell CE with some hedge and then leave it there. I would not do any put option there or sell or buy or whatever. So it's not a triangle, but it's just one CE selling just CE. So this particular statistic is very important. I will tell you why. So this is a percentile concept. What it says is open to high, right? What it says is there is this 0.9, if you're able to see this. There is a 90% probability that Nifty from after it open, it will not go above 0.81%. That's what it means. Again, I repeat the statement. There is a 90%, it's actually percentile, but then let me make it very easy for you. It is a 90% probability that Nifty, once it opens, it will not go beyond 0.81%. So that's in fact, not even 1%, 0.81%, which means that let's say Nifty is at about 24,000, right? Let's say 1% is about 240 points and 80% would be about 200 points. What it says is once Nifty opens, whatever the price it is, it will not go above 200 points 90% of the times. Okay, so that's the comment there. Any questions on that particular statement? Is that clear? Okay, this is the number. Maybe let me expand this a little bit. No, this is not a website. This is actually the code that I wrote. So I mean, if you guys are interested, you need to know Python and then Streamlit a little bit. And you can also do this for Bank Nifty. Bank Nifty also same thing. Bank Nifty, as you know, it's very volatile, right? What it says is there is a 90% probability that once it is open, Bank Nifty will not go above 1.2%. That's what it is. Now, I'll share the code, no problem. I'll in fact do a video on this and then share the code, not a problem at all. And then you can also do for FinNifty. FinNifty also 90%. 1 second. Yeah, Nifty is very similar to Nifty. There is not much of a change. And then you also can do for Sensex, and Sensex is again 87%. In fact, Sensex and Nifty are very similar. It's 81.93, but Sensex is a little bit more volatile, which is 87%. So you can also do this for open to low. Once, let's say this is useful for your, if you want to just do PE, or you can also do for open to close. Open to close in the sense you would not be much worried about what is the high, but then when it is actually getting closed, that is also important. And then you can also do for open to low. So and also it got the code, got the details around. You can also do for 2 years. 2 years also there is not much of a change. Typically I do for 1 year because 2 years is too long. So but if you go for 2 years, the values are little changed. That's all. All right, so this is what is it? Yeah, I mean, this is basically, you can also change this, right? So you can make it as, if you want to do, again, this in fact would drive your um, what kind of decisions that you want to make, right? Let's say you want to have a probability of just, let's say, 60%. So now you will go with this number. So but then this is highly risky, and you would end up into losses. So this in fact is not required. You can always put it 0, but you can always play around this one. If you wanted to have a trade which is, let's say let's say 95% accurate, for example, then you would actually do CU only at 1.09% and then leave it there. That's how you would do. Okay, all right. I'll take a pause here and then take any questions, because this is a very important thing if you're doing a day trading. And day trading, I know a lot of you have asked the questions on how do you manage the spikes, right? So suppose if you do SE spread, which you would actually sell SE and then let's say 1% or whatever. Let's take it as mid cap Nifty. Unfortunately, I do not have the data, but let's take it as Sensex. You just do this trade and then which got a, let's say, even if you take 80% probability, right? On an expiry day, you do only 6% from the price, and then just do a spread and then leave it there. Even if the spikes would happen, nothing will happen. You would obviously take some limited loss or limited profit, but there is nothing that you need to get panicked. All right, so I think one question came is how do we do the I think that's a very important one. Let me, so I do not have a mid cap Nifty, but then I'll probably pick up Fin Nifty, and I'm assuming that the Monday is expiry day, right? So, and this is like a, let's take it as 90% trade. So now if you take Fin Nifty, what is this mean is Fin Nifty, it doesn't, in a day, it doesn't go open to high. There is a 90% probability that it is going to stay below 1%, just for the argument's sake. Maybe I'll make it as 1%. Okay, there is 86% probability that is going to stay below 1%. That's the thing. Premium will be less, absolutely yes. The reason is premium will be less because that's how the life would work, right? If the moment you take, you want to have more money, you'll have to take more risk. Let's take it as Fin Nifty, right? Fin Nifty right now is at about 22,009. Let's take it as 23,000, and 23,000. The 1% of 23,000 is how much? 230. So you would get into a trade somewhere here, which is 233,300. Again, this is only for CU only call, right? So in this particular scenario, what you would do, trading strategy builder, you go here, and then yeah, you would take a sell call here, and then you would do a spread, or you can do here if you wish to, and then leave it there. So this is a 80s. Yeah, I mean, actually sensible says 93%, but my this actually shows 86%. That's all right. Yeah, so if you stay on this traded on, let's say, on Tuesday morning, so what would happen is your maximum loss is obviously, risk reward is not very favorable, but still you will not get into the panic of spikes and other things. So it actually says if you do this daily, there is out of 100 times, probably this would be successful 10 times, sorry, successful 90 times. The remaining 10 times it will be failure, but then it will stay in those range. But then only thing is, some of these things you'll have to do pretty much daily. Then you will make some money. But if you do sporadically, then you will not make money. So some of these strategies would give you more of a constant money if you do consistently. That's all. That's the way that you need to do these trades. All right, so I'll take a pause here. How about looking at the long dated call options to get back? Yeah. So Abhilash, unfortunately, I'm not very good with the options buying. Um, uh, yeah, I mean, I did very rarely options buying, to be honest. So can you explain the 1 second? So I think 1 second. Let me pick up this question. New to your network is learning path when you're beginners. Then please, okay. Let me. I'll take that as a question and a little later. 1 second. Not this one. All right. So how to adjust this when making losses? So there are two ways, Mahesh. So first is positional trade. As I said, it's very straightforward. In fact, I'm going to do a video on the positional trade, which I did a live trading on Angel. I'll show that. However, intraday, what would happen is, in fact, I'm going to cover in a moment. We are left with another 20 minutes, and positional trades adjustments are quite easy because you have plenty of time in the world. You can go on and make changes. But suppose if you are taking intraday as this kind of a strategy, I would not expect you to make any changes. So this got a, as I said, every day, even if Nifty expiry happens pretty much 52 weeks, right? So if you do this 52 weeks consistently, probably, as I said, 10 days you will lose money, but the remaining days you will make money. So that's how you will have to take it up. In positional triangles, do you do any shifting? Yeah, of course I do quite a bit. As I said, I will do a separate video because we are also 20 minutes left. I thought I will show that angel broking trade, but I do not have time today. But as I said, I'll do a separate video maybe tomorrow day after. What about black swan events, and when do we be sold on a positional basis? So see, black swan events, what would happen is if you're in the positional trade, it is always good to have hedges. I mean, there is one way to protect the. Let me cover this point. This is very important. Let's say if I go to, if I'm assuming that I'm in the positional trade, I think it's important to cover this. Okay, let me unhide this. All right. So let's say I'm in a positional trade, right? So neutral, or maybe okay, let's say we're in triangle and the positional trade you are in then. So now the one way to protect this is you will have to get into a calendar spread. In fact, I mean, you can do this, but one way to do that is you can actually go here and then do a different days, and then you can simply do a okay, not 5th September, let's say okay, 29th October. This is a different expiry, but I can't find anything here because it's fin Nifty. Let me go back to Nifty. Okay, so you are here, right? So now the way which you would handle the black swan events, but assuming that you wanted to really protect your thing, right? So you would get there and then not this expiry, but probably you will go to 31st October, and then you simply need to do a long here. So again, depending on your risk appetite, you can get on to, let's say, 3 or any of those things. It's up to you. But right now we just got one lot, right? So you will just do one lot and come back here, and then that's it. That's how you would actually protect in case if something happens, right? You will not get into unlimited losses. It will not stop you from getting into losses, just that it will not get into you unlimited losses. That's how you will be able to protect it. Okay. Okay. Now let me go back to bit on the expiry trade. I think that's what probably a lot more people would be interested as well. All right. So expiry trades have become quite famous in the recent days, right? So I assume you're able to see my screen. Let me wait for some time. Yeah, all right. So expiry trades definitely became popular after I think 2022 or whatever, right? Where pretty much you have expiry every day. I I usually liked expiry days, but except last couple of months it has been quite hectic. So I wanted to. In fact, I reduced my capital and expiry trades. I reduced capital quite a bit, but right now I still do expiry trades just because it gives the thrill. But otherwise, I would not suggest you do expiry trades quite a bit. So expiry trades again. Sometimes buyers are making money, sometimes sellers are making money. There is no way that you will be able to really come with some theory saying that only some people are making money. It depends on the day. So a couple of things I would expect you to look at when it comes to expiry trades, right? The first is definitely the open interest. It is very critical. And then you also need to look at the global cues. So sometimes they may work, sometimes may not work. But then I think 80% of the times they do work. For instance, when Japan had a challenge and then the US Fed rate got a challenge, markets fell down and India also responded pretty similar. But then there were the days where global markets went down, but India went up. So some of those abnormalities also would happen. And also you need to understand the events. The events would be, for example, RBI announcement would happen at 10 o'clock. And in fact, this Wednesday I missed that and I paid some price. But some of those events you need to definitely know. And sometimes the companies would announce the results during the market hours. But most of the big companies, they do announce out of the market hours. So mostly were saved. And anything that happens within the day that will have some bit of an impact. Let's say some coalition government getting formed or some attack on something, some of those things would definitely have some bit of an impact. And you also need to have the trend for the day, whether it is going to be neutral or up or down. That you need to definitely know. Probability model I just covered. The previous the program that I wrote, I was able to really show what is the probability model. All right. So as I said, right. So the how the day would look like, the day would be either directional, either it's going to go continuously up or continuously down, or it could be non-directional. When I say non-directional, it could be pretty much flat. In fact, I'll say perfect day for flatness was Friday. Sensex was pretty much like straight line. There was some bit of an up move and a down move, but after 10:30 it was absolutely straight. So that is non-directional. And volatile would be it will have one up move, one down move, one up move, one down move, and probably the moves would be about 5 to 7 times in a day, and most of the times you end up losing money. So these are all the things, and on top of this, the challenge is the artificial spikes, and these are all the injections that people famously call. So this is also one more big issue or the challenge. So as I said, I will talk about this in a moment, what kind of strategies that you can use. But as I said, open interest is absolutely useful. Linear regression also quite useful in the day trading, but then we should use less than an hour chart for that, including the probability or the correlation. MACD is also quite useful, and RSI definitely be useful. So those are all the important things that we'll have to do. And my favorite strategies expiry day are definitely there is a CE only, which I usually do, as I showed in the previous example, right? So even if you do 1% up on the, let's say, fin nifty or nifty or bank nifty or whatever, there is a 90% probability that you will make money, but just that you need to do continuously. And that doesn't need much of an adjustment. And yeah, I also do quite a bit of an adjusted triangle. Adjusted triangles would be start with this triangle, and you start with some volume. Let's say if the market is actually falling, right? So I tend to do more CE quantity and then less PE quantity. In case if the market reverses, I will at least gain some money on the PE, but I might lose on the CE. But my CE is usually little further from the price, so that when I have a larger quantity, in case if the price moves up, I will not have much of an impact. So that's what I do. And yeah, so these are all some of the strategies to managing the spikes, right? So 1 second, I think this, just give me 1 second. Okay, I'm not able to take away this one. Okay, all right. Okay, here I go. Okay. So, I mean, ideally in expiry day, right? So, ideally, if you are non-directional, a short iron condor or the iron butterfly, both would be important. Again, this I'm talking from the seller's perspective, not from the buyer's perspective. And then you can also do a modified short iron condor. I'll talk about that little in a moment. I'll show the real example. And then they have a staggered Excel exits and then staggered entries. I'll talk about them also in a moment. So now let me change my screen to Sensible again. All right, so this is basically whatever I'm saying is mainly for the expiry trade. Let's take it as mid cap Nifty, which is coming up on Monday. So typically, let's say the way which I would probably do is I'll go to open interest on Monday morning, maybe 9:15 or even let's say 9:30 or whatever. So right now it is actually showing 12,700 and then 12,500 or maybe 12,800 also looks good. So let me do I'll do a bit of a safer strangle, or I might do a bit of a differential quantities as well. So one of those things that I'll do now. So I will probably go here and then do this one about 11 rupees and then this one about 11 rupees. And these obviously got a bit of a wider range. And Monday morning when the market opens, obviously these numbers would be very different. I always do hedge. I never enter a trade without hedge, even if I have the capital. The reason is there are multifold, right? So I do not want to really get into unlimited exposure. That's very important. So I usually always do hedge first and then the sell later. That's very important. As I said, it nothing to do with the margin, but I do not want to get into unlimited exposure. That's the only reason. So now when you are here, right? So let's say I have 10 lots here, just for the argument's sake. So now it is actually let's play rich game. Let's say I have 2,000 lots here. All right, so this says 6.6 crores, and then you get about 19.85 lakhs, right? So that's the 3% of this particular thing. So now this is the quantity, and then this is the thing. And now what would happen is when you are, if you had seen my video on Friday, I had shown the live trade for Sensex, right? So what would happen is every second there is like you see 20,000 up, 20,000 down, and then 30,000 up. It's like every second the numbers would change. Sometimes that would create some bit of a panic. And now I think one way to deal with that is you can also do a short straddle in the middle. So short straddle in this case would be, let's say I buy here. Obviously one quantity will not make any difference, so I will probably, because it is 2,000, we'll probably do, let's say, 100 lots here. All right. So this is 100 lots. Now what would happen is with this particular thing, right? Your movements are little contained. So now the movement would be little smoother. So suddenly you will not see 2,000, sorry, 20,000, 30,000 the losses or profits. So it will slowly move from, let's say, 10,000 to 12,000, 12,000 to 15,000. That's where it will actually smoothen it. Now it will not really let you to panic. And the second advantage with this is, let's say if the market goes to any extremes, because market, if it is here, very rarely and expired, it will actually end here. Only Friday was an exception, but usually it will go up or go down. In case if the market is actually going up, you are still happy. In case if the market is still going down, you are still happy. The reason is here you are actually, in case if it goes here, you are getting 23 lakhs, and here it goes there, you are getting 23 lakhs. The only thing is if it stays in the middle, you are getting 13 lakhs. So now if I remove this, so what would happen is instead of 13 lakhs, if it stays in the middle, you are getting about 19 lakhs, but then the extreme also you are getting 19 lakhs. You will save something, but then at least it will save you from the panic. In case market falling down or the going up, you will not be much worried. Now, again, we are going with the assumption that this actually stays below 2% in that week. I think mostly if you go with mid cap Nifty, very rarely it would actually breach 2% every day. So either side. So you are pretty much mostly confident there. So now the pop says 5%, right? This is incorrect. The reason is, I think, because of this is about 95%. This is what the number. So it says 95% accurate that you'll get about 3%. The remaining 5% nobody knows. But then if you add these, obviously there's going to be some bit of a change. But yeah, you'll have to take 95% as a thing. So this is one way to really tackle some bit of a pressure and the tension. You will not really get into a lot of unlimited losses or unlimited profits. So that's very important. But then you might always oscillate. So what would happen if it goes below 2%? Obviously, you will lose money. That's where you'll have to really get into a bit of a thinking around how do you manage this. Okay, I think that's what it is. And let me again go back to. I'm a bit cautious of the time. All right, so this is how I and also a staggered SL and exit. What would happen is, let's say if I'm dealing with let's say 2000 lots, right? So staggered exit would be if, let's say, my SL on a particular leg hits, let's say I sold for 10 rupees, and then if it hits 15, I do not want to exit all the trades. I would exit only 1/3 or maybe 1/4, and then say how it happens, right? So, and the next exit I will only put at let's say 16 or 17, but that is also again 1/4, that remaining 1/4. That way you'll be able to really even if, let's say, if it touches 15 and then if it goes down, you are still okay because your 3/4 is still saved. But ideally one should not exit all the 100% trades because that would get into unnecessary unlimited. A lot of times the spikes would be fake, a lot of times, but because they are fake, you do not want to really exit all the trades, so you just exit some portion and then leave it there. All right, so that's on the. Okay, I think this is my last slide anyway. I will take a pause here and then take any questions from any of you, and I will stop sharing my screen as well. All right, so any questions to me, folks? So. Okay, so I have pasted the feedback form here. This is for me. If you guys can fill it, that would be great. You can actually see under my name. I will also put this in the. Let me give me a few seconds. I will take your questions. So just to stay online, just give me a few minutes. So I have pasted the feedback form in the live stream video also. If you can go to the description, you will find it. I will also put into the subject line. So, all right. So fill the feedback form and I'll take the questions meanwhile. All right. So, okay, let me go one by one. Okay. How much was the capital to trade with now? Okay. You'll have to do a PM DM to me, Taco. And how much capital did you start trading with? I think any of those personal questions you should DM me, send me Twitter. How much ROI do you expect? Yeah, I think this is a good question, right? So I think generally I would think we should have an expectation 2 to 3% in a month. Anything. This is how I say, right? 2 to 3% is mostly cakewalk, and 3 to 5% some bit of a stress, and 5 to 10% is a lot more stressful. I think about 10% my view is not achievable. At least I could not do so far. The max I could do is 10% in a month. That was last year August, same time. And then last year August I was between the jobs, so I could spend some full time there, about 2 weeks. So that's where I could do that. But yeah, I think the fair expectation is about 2 to 3%. Okay. So somebody SRK, learning path. See, the way that you learn is definitely. I think as far as you know the options basics, how the put and call would work, and pretty much all the things. I would still learning is just 1%, right? You'll have to do a lot of practice. The only way that you get there is to do daily trading something. That's all. There is no easy way. Okay, I think I think this is a favorite subject. Any tips to build capital? First of all, as I said, right. So start earning money, not from trading, but outside of trading, right? And then getting into my view, a lot of SIPs and in the either in the stocks or the mutual funds. That would be definitely be useful. Once you build capital, at least 25 lakhs to that 50 lakhs. That's where you get into market. That where it will be very easy. And Mahesh asked a question: which one is best, 0 DTE, 1 DTE? I think there is nothing like best, right? So I mean, any day you can make money, but then the risk is quite high in the 0 DTE versus 1 DTE and then 2 DTE. But right now, I had seen even the 1 DTE is becoming quite volatile. So I think any day is a good day, and any day is a bad day. There is no best or good, my view. Okay, all right. Thank you so much. That's fine. And any other expiry day? I think, I mean, generally, expiry day, generally, Revant, the stop losses are not working anymore, right? So there is sudden spike, and then you get hit on the P and then CE. That's where ideally I would get into a strategy which you would not put in stop losses, ideally. So let the day expire, either the losses or profits, but then you will have a defined loss or defined profit, right? That's where you will not have much of a worry. Sir, if you're not interested about option buying, please tell us about investing in stocks. So yeah, you can always. I mean, investing in stocks is always good. Personally, that's my favorite thing. I will be very open to say that I made more money in the investing stocks compared to options, but that does require quite a bit of a quite a bit of a time, and you need to have a lot of patience to get there. So that's important. Any books you recommend? No, I think as I said, books. See, as far as you know, the strategies, right? So it all goes with the practice. Strategies. I think any book that you read, it is only 1%, or any knowledge that you gain, it's all the more you gain is from doing it on the ground. The reason is the market is so dynamic, right? So every day there is a lesson to learn. So um, question on the hedge was not taken. I did not remember what. Okay, Subramani, can you please ask again? I not able to recollect what was the question. So how trading works, Vega strategy. I mean, as I said, I will not be covering Greeks this session, but maybe next time. So. Do you follow? Yeah, I personally, I think somebody asked Vedic architect. Do you follow Greeks? No, I do not follow any Greeks at all. It's quite complicated to follow. And personally, I felt they do not make much sense because Greeks anyway is derivative of the price, right? So as far as you are able to look at the price, that should be absolutely all right. Mid cap Nifty is the best index to avoid volatility because of the rest. Yeah. I mean, to be honest, I made my highest money on the mid cap. I also lost my highest on mid cap, so I do agree with you. Automation, yeah. So yeah, I mean, this is a little tricky, but I use, as I said, I think I did a couple of videos that I use an automation tool. You can look at my YouTube videos, and that helps me to not to do a lot of screen time. That's important. Uh, yeah, I think both are good bonds and mutual funds. I think one should invest. Absolutely. No, I do not do any algo trading. All the strategies are mine. Just that I use an automation tool to execute the trades. That's all. There is no other algo I use. So, Palaniswamy, I think as I said, simple. I think even if you do covered call, right, with the probability model, I think 2% my view is achievable, and strangles also would be able to do. Yeah, I mean, not a guarantee, but then obviously there got to be some months you may end up losing, but that's all right. So, out of 12 months, if you're able to earn about 9 to 10 months, that's absolutely all right. So I think this is an important relationship with falling. So in fact, VIX is a derivative of premium, and when the premiums are falling, when the premiums are going up, VIX also goes up. It's not the vice versa actually. VIX is derived from the premiums itself. So, and premiums would go up or down mainly because of the volatility, the IV internal implied volatility, right? So that is one reason that premiums would go up. And when premiums go up, VIX would also go up. That's the relationship there. Um, can we expect a 5% monthly profits by just trading stocks? I think it's very difficult to say that, Vishnu. So it all depends, right? But generally, if you look at last year has been a great bull market, right? And some people made almost like 100% returns in 12 months. But then I think that's very difficult to repeat, my view. It might take some time, but anything on the stocks, we need to be long term. Strategies on one day before expiry and carrying. I think the one day before expiry, you can look at the probability model and then see how the index would move. And I mean, 1DT generally should give money if you're able to do that overnight risk. I did on Sensex overnight risk, and that did not pay well to me. I mean, in fact, starting of the day, I got into losses, but then I had to do quite a bit of an adjustment on Friday morning. So some of those things can definitely happen. Why 3 p.m. moves I think that's because of the manipulation. Usually after 2:30 3 p.m. a lot of people do manipulation. Whoever has the money, they will take the quick bucks and then move on. So it's not the nature of the market to react violently at 3 p.m. It's just somebody is manipulating, that's all. Would you consider linear regression? Yeah, of course I do consider linear regression for intraday. And if so, what time frame? So it depends. Sometimes I do 5 minutes, sometimes I do 15 minutes. It all goes with the probability. Whatever the time frame gives the probability, that's what I do usually. When is your next class? I do not know. Depending on the time, I'll see. Reasons why you lost mid-cap Nifty. So it was a wrong prediction. It was May 13th this year. I was marked. I think mid-cap Nifty, it went down and then went up, and I couldn't really predict. And also had zero the glitch that day, and combination of those two, I did lose money on mid-cap Nifty that day. How to effectively use capital? There is an easy way to not lose capital. That's all I can tell you. I think the moment you get into 50% losses, I would say you quit completely trading. That's important. What is the ratio of straddle buy to the strangle sell? I think straddles I do not recommend an intraday, because intraday anyway there is going to be movement, except 1 or 2 days, right? So that's strangles, my view, would be better for intraday. With such capital, how do you manage broker glitches? Yeah, I think that's an important one. Yeah, we can't help much, so that's how it is. So that's how the life. On Friday to okay, this is important. Hey, Mahesh, I did make a video on Friday Sensex thing, right? I think it was at least for me, it was a great learning. Just look at that video, and then if you have still questions, DM me on Twitter. I will probably explain that in a bit more detail. So, what about charges? And many people lost money and charges during that. Yeah, of course. I think I did post my charges last week. So, I think my view, charges shouldn't cross about 10% of the total profit, but I'm at about 12.5%, 13% right now. Yeah, anything above 10%, my view is bad. So I may right now consider as a bad trader because my charges are about 12.5%. Do you sell covered calls every month? Yeah, I do mostly, but I do not do it in Zerodha. I do in my other account. So that is to protect the portfolio, definitely. No, Kite doesn't have linear regression. So it just, I think it is only there in the trading view. You have to buy that license. To sell cover. Okay, all right. I think we're also done with the time. I know it took another 5 minutes, but if any of you have any questions, I can stay for another 10 minutes at least. Feel free to drop off if you do not have any questions, but if you have questions, so Avi stock trader wrote in the capital letters. I must take it. Please explain option selling ATM, ITM, 0DT. I think it's I mean, option selling ATM is quite dangerous. You should always look at the bidder on the OTM trades. The reason is you got plenty of time to react and adjust. That's the beauty of selling, right? So if you're at ATM, you will not have a lot of time to adjust. So that's the reason. How do you manage time between IT professional and then trader? And who asked this question? To Ashwin. So yeah, as I said, I do plenty of automation that would help me to not to focus on the trading much. Most money is ideal in my account, and I use less capital in sessions, even I'm profitable. That's great. I think that's absolutely all right. So, I mean, there is always a balance between risk management and optimization, right? So, if you do not want to take risk, if you're using 10% capital, that doesn't make sense. So, ideally, I would expect at least use 50% capital, and then remaining 50 keep it for any adjustments. But yeah, there should always be balance between always be always be balanced between your optimization and the risk management. So that's where you will make money. How do you make adjustments in positional trades? So I will do a video on this. In fact, I did a couple of videos on the positional trades, but have a look at it once you get time. And I will also do a video on the current positional trade that I took for August expiry. That's a good way to learn, I think. Are you aware of? No, I am not aware. I do not watch any YouTube channels. Most of the money is ideal. Okay, all right. Let me pick up any other reasons why. Okay, I think that I answered. And okay, so I had one. Sir, do you put SL for each leg, or you are not putting? So I think it depends. It depends on the volatility on the day, right? So typically on the day trading or intraday rather, intraday I tend to not to put SL at the leg level, but to look at the overall PNL. But then if the market is too volatile, I also put this staggered SL, right? If I have let's say 2000 lots, I would put starting with let's say 300 lots NSL, and then after that in the 600, something like that. So that would mostly work, but yeah. This session is recorded. I think it is recorded. Will you be regular posting on videos? So yeah, I mean, I've been posting whenever I get time. Let's see how it goes. And probably I think this live session is quite useful to me because it's easy for me to answer a lot of questions versus doing a video. Probably I will mostly prefer to do live streaming, and that way it is easy to learn. Also, it is also dedicated time. Yeah. Otherwise, for me, sitting and then doing a video editing, that would take at least an hour. But this is probably a lot more easy. Okay, I think that's all I believe. So kindly fill that form so that it's I can probably look at how do we improve. That's important. Do you prefer, one second, uh, how far you take hedges? And so hedges, I mean, ideally you can go, let's say Nifty, right? You can probably get down to 500 points. But then what would happen is when the market is actually getting to closure, typically I want to move the hedges, mainly it will also give you more margin. Again, it's a call between margin and then the charges, right? So margin typically, if you get closure, suddenly you get into 1 crore to 2 crore kind of a margin increment. So that would be more valuable. Then that point of time I'll have to take a call between the charges and then the margin. So that's important. You take margin benefit, of course. So the way which I do is I do pledge my stocks on the portfolio, and then take the um, use that pledge money for the uh, intraday trading. Okay, all right. I think this record, I think it will automatically uploaded, I believe. I think this will stay there. Okay, definitely, Shiva. I'll do more sessions, but I think adjustments are good if you do on the live session. Otherwise, if I do this, it will become a theory. A lot of times you'll not be able to understand what is happening. Yeah, Python code. In fact, I'm going to do a video and then share in that video, so that all of you are aware how to use that code. So you need to know Python and then better on Streamlit. So there is no code changes that are required. All right, then I think I can stay another 3 minutes, 12:15. I'll close, and any last minute questions you can ask, and can close for the day. And thank you very much for wonderful session. Please do some more sessions. Okay, definitely. As I said, I will definitely do. And how to automate the strategies in a tool. So yeah, strategies. Obviously, you need to build your own strategies. Ideally, what works for your personality and then the capital, and then obviously after that you can go and then get into some more adjustments. Shika Lohit, yeah, feedback submitted. Thank you so much, Shika. Much appreciated. Revant, it's very difficult to answer that question, but strangles one day before experience. I think, yeah, 0.5%, my view is possible, but again, it goes by day by day. Kindly do a video why you are doing the adjustments and what adjustment you are doing and do and reason. Okay, I'll try this, Mahesh. Yeah, usually day trading it's quite difficult, but positional definitely yes. I have 1 point low charges in last month and 11 point profit. Or charges are more are okay. I think yeah, as I said, make 10% as the criteria, and there is no rocket science. If you are below 10%, I think you can say you are good. If the strangle value is increasing, do you exit or adjust? I think yeah, depends on the day. I tend to usually when I get into losses, so um, I tend to adjust. That's how I do. Please take care of your health and also don't waste. Okay, okay, thank you. My charges are more than okay. All right, I think that's fine. Then we are also. I'm left with another last 1 minute. Linear regression 14400. I think you need to do a bit of a movement or bit of a change and then see what works for you. There is no holy grail there, right? So anything can work, and just do bit of a multiple permutations and combinations. My charges are more than my profits overall. Then you'll have to you'll have to look at your strategies. Yeah, I'll do a video and then quote. Yeah, all right. I think we're 12:15, and then Thanks everyone again, much appreciated. And then if you did not fill the form, please do that. It would help me to improve any sessions that I do in future. And have a great remaining day and enjoy rest of the Sunday. And thanks for joining. Bye bye.